Hey everyone, welcome back to Corporate Decoder, the place where we see if this company is swimming in cash or trying to keep its head above water. Today we're diving into Atlanticus Holdings Corporation's latest report, and let me tell you, they've been busy. They just announced a massive private offering, raising a cool $400 million by selling new senior notes. These aren't just any notes, these are 9.750% senior notes due all the way in 2030. That's a pretty high interest rate, so they're definitely paying a premium to get this money. This means they're planning to use this cash for some big moves. A good chunk of it is earmarked to pay off existing debts, specifically those outstanding amounts from their recourse warehouse facilities. Think of these as short-term loans the company uses to fund its day-to-day operations or specific projects. Paying them down frees up their financial flexibility. They're also talking about using some of this money for general corporate purposes. This is a bit of a catch-all phrase, but in their case, it specifically mentions funding future acquisitions of portfolios and businesses. This tells us Atlanticus is looking to grow aggressively, buying up other companies or portfolios of businesses. This tells us Atlanticus is looking to 5% senior notes due in 2026. So it's a mix of debt management, growth, and refinancing. Now let's look at what's actually registered and traded. They have their common stock, no par value, trading under the symbol ATLC on the Nasdaq Global Select Market. Pretty standard stuff for a publicly traded company. Then there's the 7.625% Series B cumulative perpetual preferred stock, also on Nasdaq, with the ticker ATLC. All of these are listed on the Nasdaq Global Select Market, which is a pretty reputable exchange. The really important date here is August 20, 2025. That's when this deal, this offering of the new senior notes was officially completed. The company signed an indenture, which is basically the contract that lays out all the rules for these new notes. This contract is with US Bank Trust Company as the trustee. What that means is the bank acts as a middleman or a watchdog to make sure both Atlanticus and the notey holders stick to the terms of the agreement. These new notes come with that 9.75% interest rate. That's quite a hefty sum they're promising to pay out. Interest is paid twice a year on March 1st and September 1st, with the first payment due March 1st and September 1st, with the first payment due March 1, 2026. The notes are also guaranteed by certain domestic subsidiaries. This is a common practice to give investors more confidence, as it means if Atlanticus itself can't pay, these other companies within the group are on the hook. Now let's talk about how and when Atlanticus can pay back these notes early. Before September 1, 2027, if they want to redeem or buy back these notes, they'll have to pay 100% of the principal amount plus a make-whole premium. This make-whole premium is essentially compensation for the investors who would lose out on future interest payments. It's designed to make them whole or as close to it as possible. After September 1, 2027, the redemption prices become more standard, varying as outlined in the indenture. There's also a special provision allowing them to redeem up to 40% of the notes early using money from equity offerings, but with a slightly higher price of $109.24. Premium is essentially compensation for the investors who would lose out on future interest payments. It's designed to make them whole or as close to it as possible. After September 1, 2022, after 40% of the principal, this suggests they might consider selling more stock later to pay off this debt. A really critical part of these agreements is what happens if there's a change of control. This usually means if the company is bought out by another entity or if there's a significant shift in ownership. In such a scenario, Atlanticus is obligated to offer to buy back these notes from investors at a premium. Specifically, they have to offer 101% of the principal amount. This is a protective clause for the note holders, ensuring they aren't stuck with debt from a company they didn't originally lend to. The indenture also includes a bunch of covenants, which are essentially promises and restrictions. These covenants limit what Atlanticus and its restricted subsidiaries can do. For example, they can't just go out and borrow a ton of new money or issue specific types of new stock without getting approval or following certain rules. They also have limits on paying dividends to shareholders, making certain loans or investments, and cancelling off key assets, especially the stock of their subsidiaries. These are all designed to protect the interests of the note holders, ensuring the company doesn't take on excessive risk or weaken its ability to repay the debt. Of course, these restrictions come with exceptions and qualifications, which are detailed in the full indenture, and like any major debt agreement, this indenture outlines what happens if things go wrong. These are called events of default. This includes not paying the principal or interest on time, breaking other terms in the agreement, failing to pay other debts, not paying important legal judgments, or if certain guarantees fail to hold up. In more serious cases like bankruptcy or insolvency, that also triggers an event of default. These are the triggers that allow the trustee, on behalf of the note holders, to take action to recover their money. So what does all this mean for Atlanticus? This new issuance of debt is a significant move. They're raising a substantial amount of money, primarily to manage their existing debt obligations and fuel future growth. The high interest rate on these new notes signals that the market views Atlanticus as either a growing company with risks or a company that needs to offer a higher return to attract investors compared to its existing debt. The covenants and change of control clauses are standard protections for lenders, but they also mean Atlanticus has less freedom in its strategic decisions going forward. This filing doesn't include the actual financial statements themselves, but the fact that they're issuing $400 million in new debt tells us a lot about their financial position and strategy. Companies usually take on new debt when they either need funds for expansion, have upcoming debt maturities they need to refinance, or want to optimize their capital structure. Given that they are using a portion to pay down other debt and fund acquisitions, it's clear they are in a growth and refinancing phase. And finally, the report is signed off by William R. McCamey, the Chief Financial Officer. This indicates his approval and confirmation of the information presented in the filing. Now, looking at this from a bit of a distance, Atlanticus is clearly in a phase of actively managing its debt and pursuing growth. The high interest rate on the new notes suggests investors are demanding a fat premium for lending to them, likely due to the inherent risks in their business model or the current economic climate. Companies that issue debt at such high rates often do so because their existing lenders are unwilling to advance more funds or because they need to outcompete other investment opportunities for the available capital. The focus on acquisitions is a classic growth strategy, but it's also a strategy that carries significant risk if these acquisitions don't pan out, or if the new debt proves too burdensome. The company could find itself in a precarious position. The covenants, while standard, do mean that the company's strategic maneuverability is somewhat constrained for the benefit of these new debt holders. They need to be very careful about how they deploy their capital. The fact that they intend to potentially pay down their 2026 notes with this new debt is a smart move if the terms are favourable, effectively pushing their maturity dates further out, and possibly at different interest rates. Overall, Atlanticus is making bold moves. They're raising significant capital to fuel growth and manage their debt. The key question for investors and observers is whether these growth initiatives will pay off and whether the company can manage its substantial debt load effectively. The high interest rates they're paying are a red flag that they are operating in a higher risk environment. So what's your take on Atlanticus's ambitious financing strategy? Do you think these 9.75 40% notes are a smart move or a sign of future stress? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up, and for more deep dives into corporate filings, make sure you subscribe. We also have a fantastic community over on Discord, linked in the description, where we all discuss these things. Thanks for watching, and I'll see you in the next one. Auf die Wiedersehen, ihr Leute.